Preparing for a private equity fund accounting interview, management fees, GP commit, and fund expenses interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each one, you'll see what the interviewer is testing, the core concepts you should cover, and a sample answer. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through how management fees are calculated across the investment period versus post-investment period. The interviewer wants to assess your understanding of fee bases, step-down mechanics, and how LPA language drives accounting outcomes across fund life. They're also testing whether you can translate terms into operational calculations. While answering, focus on commitment-based fees during the investment period, the shift to cost basis or NAV afterward, step-down percentages, offsets, and how recycling or recallable amounts can affect the fee base depending on the LPA. In most LPAs, fees are charged on committed capital during the investment period, like 2% of total commitments, regardless of deployment. After the investment period, the fee typically steps down and switches to invested capital at cost, or sometimes NAV, net of realized write-offs. I'd confirm whether it's gross or net of reserves, and whether recycled proceeds re-enter the base. Then I'd compute pro rata by days and record the accrual each period. Question 2. How do you account for management fees in the fund's books? Accrual timing, expense classification, and cash settlement. This question evaluates whether you can connect economic terms to journal entries, period-end accruals, and financial statement presentation. The interviewer is also testing control mindset around completeness and cutoff. Make sure to cover accrual versus cash basis, monthly quarterly fee accruals, expense classification, fund expense versus offset, payable to manager, settlement through capital call or cash, and impacts on NAV and partner capital. I treat management fees as fund expenses that reduce net assets/NAV and partner capital. Operationally, I accrue the fee over the period it relates to, typically daily or monthly, with a debit to management fee expense and a credit to a payable due to the management company. When cash is paid, I clear the payable. If the fee is funded via capital call, I'll show the call proceeds and then the payment/offset to the manager. Cutoff is key at quarter end. Question 3. What are management fee offsets and how do you reflect them in fund accounting? The interviewer is testing your understanding of fee offset provisions and the difference between gross and net presentation. They also want to see if you can handle common offset categories and allocation mechanics. In your answer, talk about transaction fees, monitoring director fees, broken deal fees, the offset percentage, whether it reduces management fees or is credited back to LPs, and how you record receivables and true-ups. Offsets are credits that reduce the management fee, usually based on fees earned by the GP or affiliates, like transaction, monitoring, or director fees. A typical turn is 80 to 100% offset. Accounting depends on flow. If the manager nets it against invoices, the fund records lower management fee expense. If the fund must be credited separately, I'd record a receivable from the manager and a reduction of expense, then allocate the benefit across partners per the LPA. Question 4. How does the GP commitment work economically, and how is it reflected in capital accounts? The interviewer wants to assess your grasp of the GP's role as an LP, commitment tracking, and partner capital accounting. They're also checking you can describe allocation consistency between LP and GP accounts. Be sure to mention GP commit as a percentage of total commitments, funded through capital calls like other LPs, same expense and investment allocations, possible management fee waivers, and how it appears in the partner capital statement. The GP commitment is the sponsor investing alongside LPs, often 1 to 5% of total commitments. So the GP has skin in the game. Operationally, the GP is just another capital account. It receives capital call notices, funds contributions, and participates in allocations of investments, expenses, and distributions per the partnership agreement. If the GP uses a fee waiver or offset arrangement, I ensure it's documented and that allocations remain consistent with the waterfall and ownership percentages. Question 5. If the GP funds its commitment via a management fee waiver, what accounting and control issues do you look for? This question evaluates whether you understand fee waiver structures, the difference between capital contributions and expense reductions, and the risks around misstatement or improper allocation. The interviewer also tests your controls mindset. Make sure to cover what is being waived, timing and irrevocability, documentation in the LPA/side letter, whether it creates a deemed contribution, consistency with GAAP, IFRS policy, and disclosure implications to LPs. A fee waiver usually means the GP gives up a portion of management fees in exchange for an equivalent increase in its capital contribution or a special allocation. I'd first validate it's permitted and irrevocable for the period. Then I'd avoid double counting. Either record lower fee expense with a corresponding GP contribution, or treat it as a reallocation mechanism, depending on the structure. Key controls are approval evidence, accurate partner allocations, and clear disclosure so LP reporting ties to economics. Question 6. Differentiate organizational expenses versus operating fund expenses. How are each treated and allocated? The interviewer is testing your understanding of expense taxonomy, capitalization versus expensing, and allocation rules across partners and vehicles. They also want to see if you can tie treatment to LPA limits and reporting. While answering, focus on organizational expenses, formation, legal setup, often amortized or expensed per policy. Operating expenses, audit, admin, legal, travel, expense as incurred. Caps, limits, and allocation across the fund. Blockers and parallel vehicles. Organizational expenses are costs to form and launch the fund, entity setup, initial legal drafting, and registration. Whereas operating expenses relate to ongoing operations like audit, tax, admin, and routine legal. Treatment depends on policy and LPA. Many funds expense organizational costs as incurred. Some amortize over a short period if allowed. Operating expenses hit the P&L as incurred. Allocation follows the agreement, often pro rata across partners, and also appropriately split among parallel funds or SPVs benefiting from the service. Question 7. How do you handle broken deal expenses in PE fund accounting, including allocation across multiple funds or co-invest vehicles? The interviewer wants to assess your practical handling of a high judgment area, identifying deal-related costs that don't close, applying LPA allocation rules, and ensuring fair treatment across related vehicles. In your answer, talk about what qualifies as broken deal costs, whether they're borne by the fund or manager, allocation methods across funds pursuing the deal, timing of recognition, and documentation audit trail for the allocation rationale. Broken deal expenses are due diligence, legal, and advisory costs for deals that don't close. First, I confirm the LPA. Some require the fund to bear them. Others push certain items to the manager. If multiple funds or a co-invest vehicle were intended participants, I allocate costs based on expected participation, often by target ownership or commitment capacity, supported by an internal memo. I expense them when incurred, ensure the payable is recorded, and track separately for LP reporting and potential fee offsets. Question 8. A management fee is charged quarterly in advance. How do you book it at invoice date and at month end? This question evaluates your accrual accounting mechanics, prepaid expense treatment, and your ability to handle timing differences cleanly. The interviewer is looking for correct entries and a disciplined close process. Be sure to mention prepaid versus expense recognition over time, daily or monthly amortization, payable and payment timing, and ensuring NAV reflects only the earned portion at month end. Include clear journal entry logic. If fees are billed in advance, I initially record a prepaid for the unearned portion. At invoice, debit prepaid management fees or split between expense and prepaid if partial period earned. Credit payable to the manager. Each month end, I amortize the prepaid. Debit management fee expense, credit prepaid, based on days elapsed in the quarter. When cash is paid, I debit the payable and credit cash. That way, NAV reflects only the earned fee through the reporting date. Question 9. How do you decide whether an expense should be allocated to the fund, a portfolio company, or the management company? The interviewer is testing judgment, governance, and your ability to apply who benefits principles under the LPA and policies. They also want comfort you can flag conflicts and avoid misallocations. While answering, focus on benefit received, LPA expense policy guidance, related party considerations, examples, deal legal, portfolio monitoring, office overhead, approval workflow, and the need for consistency and documentation for audit and LP transparency. I start with the governing documents and the fund's expense policy. Then apply a simple test: who benefits and who is obligated to pay. Fund level items like audit, admin, and fund legal typically stay with the fund. Portfolio company specific costs like add-on diligence or financing fees tied to that company are often charged to the portfolio company if permitted. Manager overhead, salaries, rent, normal operating costs belongs to the management company. I document the rationale and route exceptions for compliance approval. Question 10. Explain how fund expenses flow through NAV and partner capital accounts, including the GP's share. The interviewer wants to assess your understanding of how expenses reduce net assets and how allocations are posted to individual partners. They're also testing that you can explain fairness and mechanics clearly. In your answer, cover expense recognition, impact on total NAV, allocation methodology, usually pro rata by ownership commitment, posting to partner capital, any special allocation terms, and consistency for GP and LP capital accounts. Fund expenses reduce the fund's net assets as they're recognized, so they directly reduce NAV. Then, in the partner ledger, I allocate the expense to each partner's capital account based on the LPA, most commonly pro rata by commitment or capital balance for that period. The GP's commitment participates the same way unless there's an explicit carve-out. Practically, I post a fund-level expense entry and then a partner allocation run that debits each partner's capital for their share. Question 11. How do you treat VAT, GST, or withholding taxes on management fees and fund expenses in the accounting records? This question evaluates your ability to handle tax-related cash leakage, recoverability, and proper presentation. The interviewer is also checking if you understand jurisdictional complexity and controls around tax documentation. Make sure to cover gross versus net invoicing, recoverable versus non-recoverable VAT, as receivable versus expense, withholding tax reducing payment but not necessarily expense, documentation, tax invoices, certificates, and reconciliation to tax filings. For VAT GST, I first determine recoverability. If recoverable, I record the VAT as a receivable and only expense the net amount. If non-recoverable, the VAT becomes part of the expense. For withholding tax, the fund may pay the manager net and remit tax to the authority, but the expense is typically recorded gross, with a credit to withholding tax payable. Controls include validating tax invoices, correct rates by jurisdiction, and reconciling remittances and recoverable balances to filings and confirmations. Question 12. What's the difference between fund-level expenses and portfolio company expenses when calculating management fee bases, like invested capital at cost? The interviewer is testing your understanding of fee-based definitions and how cost basis is constructed. They want to see if you can distinguish what increases invested capital and what should never inflate the management fee base. While answering, focus on invested capital at cost, typically being purchase price plus capitalized transaction costs, if permitted, excluding ongoing fund expenses. Treatment of follow-on investments, write-downs, write-offs effects post-investment period, and consistency with LPA definitions. When fees step down to invested capital at cost, the key is the LPA definition of cost. Typically, it includes the purchase price of investments and may include certain deal-related transaction costs that are capitalized to the investment. It should not include ongoing fund operating expenses like audit, admin, or routine legal. Those reduce NAV, but shouldn't increase the fee base. Follow-ons increase cost as contributed. Post-investment period, some LPAs reduce the base for realized or written-off investments, so you need tight cost tracking. Question 13. How do you handle expense allocations across parallel funds, feeder master, or different share classes with different fee terms? This question evaluates your ability to operationalize complex structures and ensure equitable allocations. The interviewer is looking for awareness of allocation drivers, different fee terms, and how to keep records audit-ready. In your answer, discuss allocating based on relative commitments, invested capital, or NAV depending on the expense and structure. Handling different management fee rates, using consistent allocation keys, and maintaining transparent support for auditors and LP reporting. I separate expenses by what they relate to, then allocate using a rational, consistent driver. Fund-level expenses might be split across parallel funds based on commitments during fundraising and based on NAV or invested capital after deployment. If a feeder master structure exists, I keep expenses at the appropriate level and eliminate duplicates. For different share classes with different fee terms, I calculate fees at class level and allocate shared costs using a documented key. The goal is fairness, repeatability, and a clear audit trail. Question 14. Describe the end-to-end process for validating a management fee invoice and ensuring it ties to the LPA terms. The interviewer wants to assess your process discipline, attention to detail, and control mindset. They're testing whether you can independently recompute fees, identify errors, and document evidence for audit and LP inquiries. Be sure to mention recomputing fee base and rate, checking dates and step-downs, offsets, investor admissions exits, commitment changes, FX if applicable, approvals, and maintaining work papers that reconcile to the GL and partner statements. I start by pulling the LPA/side letter fee terms, rate, fee base, investment period end date, step-down, and any offsets. Then I independently recompute the fee for the invoice period, including day count, admissions closings, and any excluded commitments. I verify offsets applied and confirm FX rates if commitments are multi-currency. Next, I tie the amount to the capital call schedule or cash balance and confirm approvals per policy. Finally, I save a work paper that reconciles invoice, calculation, and GL posting for audit support. Question 15. Give an example of a common mistake in PE fund expense or fee accounting and how you would detect and fix it during a close. This question evaluates your practical experience, problem solving, and ability to design checks. The interviewer wants evidence you can detect anomalies, correct entries, communicate impacts, and prevent recurrence through controls. While answering, include a specific error, wrong fee base, missed accrual, misallocation, duplicate invoice. Detection method, recalc, variance analysis, aging, reasonableness tests. Correction entries, LP communication considerations, and a preventive control. A common issue is using total commitments for management fees after the investment period when the LPA requires invested capital at cost. I'd catch it via a period-over-period reasonableness check, fees not stepping down when the investment period ends. and by recalculating the fee base from the investment cost schedule. To fix it, I'd book a true-up entry, reducing management fee expense and adjusting partner allocations. Then update the fee model and add a close checklist control tied to key LPA dates to prevent repeats. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.